Well, so far this month, we're off to the weakest monthly start for equities since March. And our next guest says he does not see a turnaround. What should investors do? Eric Green, portfolio manager at Authentic Asset Management. I always tease you for being bearish. And you're still, what's your phrase?
I'm not so much bearish as really cautiously pessimistic. And you know, it's interesting. We've talked a lot about how things are evolving over the last year or so. And, you know, if you'd asked me when the S&P was at 4,100, where is the next move, you know, in terms of 10%, you know, I would have said 10% lower is a 10% higher. So clearly I've been wrong over the past several months. And
we'll still keep you around, though.
I'm sorry?
We'll still keep you around,
Oh,
though.
good, thank you. But, you know, where I've been really surprised is in terms of the resilience of the economy, the resilience in terms of hiring. You've seen households, and I'll speak in terms of the U.S., they've been terming out liabilities. And so the real pain in terms of the big interest rate hit has not yet materialized. You've had these fiscal injections from time to time from the Infrastructure Act. All of these things have sort of kept things a little higher than I would have expected. But this is a probability game, Amber. And when you say, well, what do you see? Well, I see a lot of things that are source of concern. First of all, is the global economy going to lift growth here in North America? Well, no. Look at China, look at Europe, and I think when you look at the U.S., and you peel away the data, what you're seeing are all the elements that you would typically see in terms of a slowdown. Sales expectations a lot lower, hiring intentions a lot lower. The surplus of jobs to fill in the JOLT survey also moving a lot lower. The work week a lot lower. So when you throw all of these things together and the slowdown in credit growth, when the absolute collapse, by the way, and people aren't talking about this in terms of money supply, you have to ask yourself, well, where am I going to be surprised on the upside here? And in a market which is priced, I think, around a multiple of 18 times forward earnings of 2024, which is set for, I think it's around 245, that strikes me as hoping for the best. And at these levels, I just am not interested in being involved.
I'll tell you where you're going to be surprised. You're going to be surprised that growth is higher. And I'm using the Atlanta Fed's GDP Now forecast, which now says third quarter is tracking 4.1%. A blue chip consensus is sub 1%. So that's where you're going to be surprised.
Well, you know, I've been very surprised over the last 6 months. But I'll tell you this one thing about it. GDP Now just takes incoming data over the course of the quarter and sort of filters that in, extrapolates it out. It could be 4% right now. It could be 1% a month from now. But I'm really looking forward, not so much what's going to happen in the third quarter, even the fourth quarter, but I think what we're seeing are all the elements of a significantly slower economy. And against this backdrop, you also have to just sort of take a step back and ask yourself, well, where's the growth going to come from? You don't have any, if you look at productivity, despite the suspicious bounce that we had in the last quarter, that's been very weak. Labor force growth hasn't exactly been strong. And then when you look at all of these other elements where the lagged effects of this big rise in interest rates are going to bite, I just cannot be excited about next year.
But that's not why the market is rallying. I mean, they're not rallying on growth hopes. They're just rallying on the fact that we might not get a recession. We might get 0.1% growth, and that would be great because it wouldn't be contraction.
That would be a soft landing.
That would be a soft landing, and that means the Fed, I think Goldman has now said, we're going to get rate cuts the middle of next year. Everything's going to be great.
Well, let's talk about that, for example. So when somebody's calling for rate cuts next year, is that unreasonable? Absolutely not. It's certainly not when you listen to me. But let's just look at inflation. Now, if you look at core inflation, and again, I'll look at the U.S., for example, odds are pretty good that by December we'll be looking at a year-on-year rate of around 3.2, 3.3, not unlike where the headline is right now. So if you look at the recent pattern in terms of where prices are evolving, just go into next year, prices will be somewhere between 2.5% to 3%. Now, ask yourself this question. So what does the economic backdrop have to look like for the Fed to begin to cut rates when they're 50 basis points to 100 basis points above their perceived 2% target? And I think, number one, I think it's going to be a lot worse than people expect. Number two, I think that the Fed is probably targeting, with a wink and a nudge, 2.5% to 3% inflation, as opposed to 2%. And if you look at the five-year forward break-even rates, you've been seeing that rising pretty considerably over the last couple of months. And so I think there's a lot of things in play right now. And you're right, a soft landing is very much in the cards. But a soft landing, to me, say 0 or 0.1 or 0.2%, is not consistent with earnings next year of 245, not when profit margins are falling and revenues are falling too. So I just think that we just have to be really cautious about getting too carried away here. And for my money, and I was wrong 4 months ago when I said this, but for my money, the next 10% is clearly lower.
Okay, so where are you going to go?
Well, short credit, for example, long treasuries, not the long end of the curve. I like the 1 to 3 year sector of the curve because that's the most sensitive to changes.
Because you've seen the long end.
Yeah, it's very troubling when you begin to see. We had the S&P downgrade. We can debate the finer merits if that made sense or not, but we have a governance problem in the U.S. And we have a big supply issue in the U.S. And when you're spending $1 trillion on interest rate costs, is that sustainable? Well, the short and long answer is no. So I wouldn't want to be on the long end of the curve, although I just do think that also has room to rally lower in yields. But I think the front end of the curve is going to give you the best protection and the best rate of return.
What do you mean short credit? Like corporate debt?
Yeah.
Any high yield or even like investment grade?
Well, if you look at HYG, for example, right, which is a combination of that would be a good place to be, right?
To short it.
To short it, yeah.
And there would still be room to short it because it's already pulled back?
It's pulled back some, but it has a lot more to go.
And what's that predicated on?
Just much weaker economic growth, much higher interest rates, much more difficult environment, especially for smaller businesses. Now, don't forget, when you look at the large cap stocks that have been really powering this rally, these guys aren't too worried about the cost of borrowing because a lot of that's been termed out. So for the next year, they're looking very, very good. But what you're prepared to pay I think is going to be higher as opposed or lower as opposed to higher, sorry.
I know that so much of your focus is on capital preservation as well, that's something you spend a lot of your time on. But are you, in case you're wrong, are you going anywhere for beta in the portfolio in case there is that upside surprise that you'd feel comfortable with?
Yeah, we do have outside protection, downside and upside.
Yeah.
We like to manage our beta exposure because we have these elements, other elements in terms of event-driven returns, M&A and other things that provide us a nice return. Right now, we're more cautious in terms of managing our beta exposure than we have been at any point in the last 4 or 5 months. And I have a strong suspicion that we're going to be right.
Okay, well, you're going to come back on, and I'll tell you whether you were or not.
You'll tell me that I was wrong.
All right.
But this is...
All right, I appreciate it.